Hello and welcome to this introduction to Alliance Trust. Many of you may have heard of Alliance Trust as it's been around since 1888, but it has undergone quite some change in recent years. Indeed, in April 2017, we at Willis Towers Watson took over the management of the trust as that was outsourced. Previously, it was a multi-asset trust that included private equity and mineral rights and a number of other assets outside of equities. But as of today, it's a 100% equity investment trust run now on a multi-manager basis. Now, your first question might be, who is the Willis Towers Watson? Now, we're one of the largest investment groups out there, but we tend to historically work primarily with large institutional investors such as pension funds and sovereign wealth funds, advising them on all aspects of investment, asset allocation through to manager selection. Indeed, we run over $140 billion of assets on a multi-manager basis, just like we are with Alliance Trust. Now, we've been selecting a different combination of managers for decades on the kind of approach that we're following specifically within equities for Alliance Trust. But this is the first time in the last 3 years that we've been able to bring that skill to the UK retail market. So what is it that sets Alliance Trust apart from others? Well, what we've done here is put on a single slide what are the 6 key differentiators as we see them. So starting on the left-hand side with conviction. Unlike the typical approach in a multi-manager offering, what we do is we ask each of the underlying managers just to give us their 20 best stock ideas. So they're not asked to worry about risk relative to benchmark or peer group in the short term. Instead, just give us their best ideas. Secondly, risk control. Well, this is one of the big advantages of a multi-manager approach. By blending the styles and approaches of multiple managers, you're not beholden to one single style or approach. Styles can be in favour for a few years, but they can then be out of favour for a few years after that. Instead, we're able to have a more smooth performance track record because of how we've blended the managers. Next up is exclusive access. And so in the managers that are in place within Alliance Trust, many of them don't actually have an offering in the UK retail space apart from via Alliance Trust. And none of them have their 20 stocks best idea approach available in retail space other than via Alliance Trust. On dividend growth, we've now had 53 years of consecutive growing dividends for the trust. And one of the big advantages of Alliance Trust is that we've got a deep set of revenue reserves that we can dip into should income fall below the required amount to pay out dividends in a particular year, so that we can continue that progressive dividend policy for years to come. Next up, sustainability. So what we do is we ensure that each of the underlying managers embed E, S and G, so environmental, social and governance factors, into their assessment of the companies that they invest in. On top of that, we measure how the portfolio looks on carbon analytics, for example, relative to the benchmark as a whole. And we also employ an engagement overlay specialist who are there to engage with the companies that we're invested in and try and make them best in class in the E, S and G areas that I mentioned earlier. In addition, they make proposals to each of the underlying managers on how to vote on the various resolutions that come up at those companies. And then finally, we can do all of this at very low cost. And so one of the advantages of using Willis Towers Watson is that we can bring our brand and scale to the negotiating table. And we've been able to get all of this with an OCR of less than 0.65% per annum, much lower than the typical costs of multi-manager approaches, whether that be in investment trusts or indeed even in the open-ended space as well. So why 20 stock portfolios? Well, there's a lot of evidence out there in academia and certainly from what we've seen in working with managers over many years, that those that run highly concentrated portfolios genuinely do on average outperform. And then of course, if you can find the most skilled within that, they can outperform quite significantly. We've put up here on this slide an example of one of those academic papers. There are multiple ones out there. In this particular paper, what they did is they took the amount of risk that each of the long-only equity funds that are out there run against their benchmark. And so the ones that run the least risk relative to benchmark, so think of them as closet index trackers, are the ones on the far left-hand side, and those on the far right-hand side are those that run these more concentrated, think of these 20 stock type portfolios, not worrying about risk relative to benchmark in the short term. And what it shows is that those on the right-hand side significantly outperform, whereas on average those on the left-hand side underperform. Actually, most products that are out there on the market fall into the left-hand side rather than the right-hand side, because managers are understandably concerned about being fired because of the volatility that running highly concentrated portfolios brings. But if you can put a number of those managers together that run these highly concentrated portfolios, then you can manage that overall risk of the portfolio. And so that's exactly what we've tried to do within Alliance Trust. Really start fishing in a pond that's most apt for finding alpha or outperformance in the first place. And that's what this trust is all about. So I've said it's a multi-manager approach. Who on earth are the managers that underlie it? Well, first thing to say is that we started off with 8 managers underlying the portfolio. In 2019, we actually added a 9th. So here on the slide, we've put out who those 9 organisations are. And you can see that that's geographically split between the US, the UK and Canada currently. But this lineup will change over time as we find new managers that we think will add something to the portfolio, or as something changes at any one of these particular managers. Now, if you look through the group here, some will be more well known in the UK retail space than others. So Ben Whitmore and Hugh Sargent, for example, at the bottom there, would be known quite well in the UK retail space. And you could get access to their approach, but you couldn't get access to their 20 stock portfolio other than via Alliance Trust. Some of the others actually aren't known at all in UK retail space, may not even be known in the UK institutional space. And so there are examples there like C.T. Fitzpatrick from Vulcan Value Partners, like Andrew Wellington from Lyrical, the people there mentioned from Sustainable Growth Advisors, all probably less well known in the UK space. Now, within this, we've got quite a blend of styles. So there's some managers that would see themselves as more value oriented. And so Andrew Wellington at Lyrical in particular would be one of those, as would Hugh Sargent from River and Mercantile and Ben Whitmore from Jupiter. Others much more growth oriented, Sustainable Growth Advisors in particular, Rajiv Jain at GQG Partners, others that fit somewhere in between. And what our job is to find great managers, but also think about how to blend those managers to ensure that stock selection drives everything, as I mentioned earlier. So an obvious question is how the trust has performed since we've taken over on the 1st of April 2017. And essentially it's performed about in line with benchmark over that period. And the reason is because it's had a significant headwind to stock selection. Now, if you think about the majority of situations, you would expect the average stock that makes up the market to perform about in line with the market as a whole. What we've actually seen in the last 2 to 2.5 years is something very different to that. The vast majority of stocks have underperformed quite significantly because the market has been driven by a very small number of companies that have done very, very well. Those are very large mega cap companies. And so that's quite a headwind to an approach where it's just picking your favoured 20 stocks from anywhere in the world. You tend to end up with a slight bias away from the mega cap and towards the mid and maybe the small cap in some instances. Now, most of the time that bias is quite small and doesn't make too much difference. We've had quite an extraordinary situation where the market has been led by so few stocks. Despite that, we've been able to keep pace with the benchmark. And so if you think of any other kind of environment, which is the norm, so we either get a neutralization of that outcome or indeed we get a reversal. And some of those mega cap companies that have led the market over the last few years tend to struggle over the next few years, then in that scenario, this trust is incredibly well set to perform from here. We've actually had very strong stock selection within each of the size buckets. It's just that it's been underweight the size buckets that have done particularly well. If we actually look on this slide here, that shows that in a bit more detail in how extreme that has been over the month, year, and 3 years to the end of April. You can see quite how extreme the difference between large cap growth and small cap value has been over this period. Actually, already since the end of April, we've started to see some good performance from the trust managers, and so maybe there's a question as to whether this is the start of some of that kind of reversal from here. So let's dive in and have a look at what the portfolio looks like, and we've done that relative to its benchmark, the MSCI All Country World Index. And I think the first most striking thing you'll notice is that it looks pretty similar to the benchmark at a country level and at an industry sector level, and that will be the case, and we've designed it that way. As I said earlier, we want stock selection to drive everything in this trust, and so by choosing managers that think very differently about the world, and then by our overall risk management process in terms of changing the weightings between the managers to ensure that it's relatively style neutral and relatively close to the benchmark on an industry sector basis and a geographical basis, it will always look like that. What you can see is that the one bias that it has is that slight underweight to the mega cap as set out at the bottom there, and that's what I was talking about in terms of what's been the headwind over the 3.25 years since we've been taking over the management of that trust. Now, you could look at this and say, well, if it looks very similar to the benchmark, how can it outperform? Actually, if you look at it from a stock bottom-up perspective, it actually looks very, very different from the benchmark. So one measure that's often used is active money or active share. And what that does is it looks at how different is the portfolio to the benchmark at a stock basis. And the active money on this portfolio is around 80%. That's very high for a multi-manager approach. Indeed, it's quite high for a single manager approach. And so there's ample opportunity for significant outperformance. And indeed, we've seen significant stock selection outperformance within each of the size buckets, as I mentioned before. Another question might be, how has this changed after the COVID-19 crisis started at the middle of March in the UK, obviously earlier in some parts of Asia, later in other parts of the world? Well, what we've actually seen is that the managers have re-underwritten all of their positions. There was a little bit more turnover in the portfolio in March than you would typically see in months. But remember, these managers think quite long term. It's their 20 best ideas. In most of those, they are still comfortable that those companies are very solid. They're going to survive no problem, strong balance sheets going into this crisis. But there have been some changes to the portfolio, but again, primarily at a stock-specific level. I said earlier that we've been able to do all of this at a competitive cost. And what we've done on this slide is try to put that in context. Because of Willis Towers Watson's assets under management and assets under advice, we're able to negotiate fees with the managers. But also because of the long-term approach of the underlying managers, the transaction costs are relatively low as well. And so what we've put on here is a comparison of the KID costs, the all-in costs, versus a number of other large investment trusts in the sector. So an OCR of about 65 basis points, 0.65%, and an overall KID cost of about 1% makes Alliance Trust look very, very competitive relative to others in the sector. As I mentioned earlier, the board has a progressive dividend policy for the trust, and indeed 2019 saw the 53rd consecutive year of dividend increases. And the board is committed to maintaining its progressive dividend policy in any challenging market environment like the one we're going through today. And we've got £110 million worth of revenue reserves that can be dipped into, as mentioned previously as well. That represents 2 years dividend cover. So in summary, we think the Alliance Trust has some significant advantages against others on the market, be that a single manager approach that makes up the majority of the market, or indeed the increasingly popular multi-manager approach. Relative to the single manager approach, there's clearly the risk advantages, not only of minimizing the style risk and being able to have stock selection dominate, but also just no key man risk for any particular individual or firm. Relative to other multi-manager approaches, the high conviction approach that we've got here with the 20 stock idea allows higher expected returns going forward. We can do all of this at much lower cost than other multi-manager approaches that are out there, and we've been able to integrate sustainable thinking into the entire approach. So that's the summary of the Alliance Trust approach. Thank you for listening.